Hello and welcome to Super Informed Radio, a UniSuper podcast. My name is Lyndon and look, we are coming off a month that's given investors plenty to chew on. Renewed volatility, we've had plenty of uncertainty offshore, of course, and the usual big questions around inflation and interest rates. So we're recording this podcast on the morning of the 1st of May in 2026, and as we head into May, really those questions aren't going away. But for us, aren't we lucky that across from me sits David Colosimo, UniSuper's head of fixed interest, who I can see is ready and raring to give us all the answers. David, welcome.
Thank you, Lyndon.
Now, David, I was nudged just before we started recording that this episode actually marks our 4th birthday or anniversary or whatever you want to call it of doing this podcast. So happy anniversary birthday to you and, in fact, to all of our listeners.
Happy anniversary.
Anyway, let's pack away those birthday candles and get down to business. Now, the last time we caught up, we focused a lot on the war in Iran, and we were talking about how share markets across the board had been pretty weak in March. Would it be fair to say that in April, fortunes were a little bit more mixed?
Yeah, mixed fortunes is a great way to describe it, Lyndon. Let's start with the US market. That's the biggest market in the world. As you said, weak in March. But in April, it recovered by more than 10%. Now, that's the strongest monthly return in more than 5 years. So once again, we're sitting at new highs in the US market despite the war with Iran. Now let's compare that to Australia. So we did see a bit of a rebound from that March weakness, but shares are up only a touch over 2% in April. So that's a lot more subdued. I did mention US shares are at all-time highs, but Australian shares are still about 6% off that pre-war peak. And then most of the other major markets, they were somewhere in between. China was up 8%, India and Japan both up 7%, and Europe nearly 5%.
I do have lots of questions, David, but let's start with this one. How did the US manage to rebound so hard given the ongoing conflict with Iran? You know, we've got the Strait of Hormuz is still closed. Oil isn't flowing as it normally would. How is the share market ignoring all of that?
Well, it's an excellent question, Lyndon. So let's start with the war in Iran. Now, there was obviously significantly less military action in April than March, but it didn't feel like there was any less uncertainty given, let's call it, the inconsistency of US foreign policy. There was a ceasefire for most of the month, but we've had breakdowns in negotiations, and not only is the strait still closed from Iran's side, but now the US is blockading Iran's passage of it as well. So as you say, still no oil flowing, and really the flow of oil is the main risk when it comes to the global economy. Now, having said that, financial markets work by expectations. And in that respect, the month of April was really divided into two halves. In the first half, expectations were that a deal was close, so oil prices fell for the first half of the month. And then in the second half, negotiations stalled, and that renewed concerns over a longer period of disruption. Oil prices went up again, and various markets reflected that. Bond yields increased. Some share markets, such as Australia, which had started to rebound, they weakened again.
So we had all these worries about US oil prices, David, but US shares just got stronger.
Well, basically, the US share market shifted its focus away from Iran and started to focus on a few other things. So I'd highlight two. The first is US reporting season, which started this month. In the last couple of months, US earnings expectations just continued to increase despite the war. And the actual results during reporting season have also been pretty positive. Now, a lot of that's thanks to the tech sector. But by the time reporting season's finished in a few weeks, it should show that aggregate US profits are up about 18% over the past year. Now, that's the fastest growth since the pandemic rebound 4 years ago. Now, the second thing is the market's become very excited about AI again. Anthropic released a new version of Claude Code, and then they announced the fabled Mythos platform. Now, that's apparently so effective at identifying cybersecurity risks that it hasn't been released publicly. It's only been given to a few select companies in the US tech and financial sector so far, and that's allowing them to find and patch the holes in their IT systems. So we went from this period for a couple of months where the market was worried whether there'd be an economic return on all of this AI investment. But very quickly, the market switched focus to the shortage of AI compute relative to this surge in AI usage. And so therefore, market's seeing a shortage of AI hardware like memory chips and GPUs. And so we've just had this remarkable strength in tech in April. At one point, the NASDAQ was up for 13 consecutive days. And the semiconductor index, which now makes up about 1/6 of the US market, it was up 38% in April. Now, Intel, which delivered a big earnings surprise a week ago, was up 114% in April, and it's finally beaten its all-time high from the 2000 dot-com boom. Micron was up 53%. AMD was up 74%. Now, NVIDIA, which is, of course, now the world's biggest company, that was up more than 14% in the month, and at one point it topped $5 trillion in market cap. So on its own, that would make it the fourth biggest share market in the world. Hard to believe that it was just a $300 billion company less than 4 years ago. And the rest of the mega cap tech names, they were also strong. So Google up 33%, Amazon 27%. Microsoft and Meta, they were still strong, but they lagged a little bit, up 10% and 7%. I think it's interesting that both of those last two, Microsoft and Meta, they've announced big job cuts in April, 8 or 9,000 each. And that's just so they can make space in their budget for more AI spending. But my favourite AI headline was the company Allbirds. It was a sustainable footwear company, but it sold that business, transformed itself into an AI company that rents GPU computer chips. It was up 116% in April because of that transition.
Oh, AI. So, David, everything essentially AI-related has surged then, is what I'm hearing.
Yeah, but actually the rebound was a little bit broader than that. The equal weighted index was up about 5%. So that is a good indication that more than just IT was up. Now, the US banks are a good example. They reported positive results. They had good trading profits, signs of a healthy US economy. The biggest banks like JP Morgan, Citibank, Bank of America, they were all up between 6% and 13%. Consumer stocks, industrials, property, they were also up.
But David, it wouldn't be an episode of this podcast if we didn't cover some weakness. There must have been some weakness somewhere. Where was it this time?
Well, yeah, some of the defensive sectors were a bit softer, especially healthcare and utilities. And given the oil price, the energy sector was also down. Exxon, for example, was down 9%.
Okay, David, so the US very strong, as you say. Why was Australia different?
Well, the first thing to say is that I think Australian shares, like in the US, they actually did start the month quite well, but turned sharply in the second half of the month and actually fell 10 out of the last 11 days. Now, a lot of that was the concern I mentioned earlier when oil prices were surging again in the second half of the month. But I think there's a couple of other things going on in Australia as well. Now, the first thing is obviously our tech sector is a lot smaller than in the US. So even though it was up by 13%, that has much less of an impact on the overall market. Now, while we're talking about the tech sector, I would highlight that there was a 28% rise in NextDC. It raised some capital during the month to fund its biggest contract win ever. And then secondly, in Australia, there were a few damaging company announcements, especially in healthcare. Cochlear fell 44% after they slashed profit guidance. CSL also fell 12% in the month. And finally, I think in Australia there's just this view that rate hikes and higher petrol prices, they are starting to have an impact on the economy. So a few of the retailers were weak. Two of the major banks, Westpac and NAB, they issued profit warnings on higher provisions for credit losses. They were both down 2.5% and 4% respectively. Now, as you said, I do also like to find some pockets of strength, and I think in Australia's case, that's the lithium producers. Liontown was up 38% in April.
Okay, David, let's look forward to the month of May. Now, I'm assuming the primary focus for you and many in the world of investments is going to remain on how things play out with Iran. Is that pretty much on the ball?
Yeah. Definitely. I think whether and when the Strait of Hormuz will be reopened to oil tanker traffic, that remains key. It's easy to forget this is the biggest reduction in oil supply in history. Now, every day the strait is closed, the world is having to run down inventories of oil by somewhere between 10 and 15 million barrels. So every day it goes on, the problem gets more dangerous for global growth. And I think that shortages will become more acute in May. Here in Australia, for example, we're probably going to see news headlines that our stocks of diesel are falling in the month, and that's going to be hard for the market to ignore.
So surprise, surprise, geopolitics, still a key driver of markets.
Yeah. For sure. And while we're on geopolitics, assuming it doesn't get postponed again because of Iran, US President Donald Trump, he's scheduled to meet Chinese President Xi Jinping in Beijing in the middle of May. I think probably a lot of talk about tariffs, access to AI, national security, they'll all be big points of discussion.
We've also got the last half of US reporting season to go, David. What about here in Australia? Is there anything coming up here?
Well, we do have 3 of Australia's 4 major banks. They report their half-year results over the next week. In fact, ANZ actually just released theirs before I walked in this morning. Otherwise, most other Australian companies don't report until August. But what we do see and what we are starting to see is that more companies are providing guidance on how the year's been going. Now, there is an important investment conference next week where some of those companies will be talking. And I think between the rate hikes, high energy prices, the stronger Australian dollar, and concerns about potentially a softer consumer, there's a pretty good chance we'll probably see some further downgrades announced at the conference.
Now, David, we've also got the federal budget in a few weeks' time. I think it was it the 12th of May, maybe from memory?
Yep.
Well, what are you looking out for on that front?
Well, normally I actually don't expect much of a market impact from the federal budget. But it will be interesting to see if the government unleashes some new cost of living stimulus. So that could be good for retailers if that happens, not so good for interest rates. But it also looks like we're going to get some changes to capital gains tax on housing in particular, and that could have an impact on the banks.
Very good. Before we go, I do need to ask about the central banks. So the RBA, you were sort of alluding to there, they're meeting next week, and we were hearing probably a rate hike this time around. Is that still the case?
Yeah, Lyndon, May 5th, they meet. Keep in mind, Australia already has an inflation problem, even before the indirect cost pressures that are inevitably going to come through from higher energy prices. Now, we did have some inflation data a few days ago. That was a touch softer than expected, so that's quite good. But I think it's still too high for the RBA, and most economists still expect another rate hike next week.
Okay. And what about the US Federal Reserve? What are they up to?
Well, they actually just met a few days ago. It was Jerome Powell's last meeting as Fed chair. There was a decision to hold rates steady. That was largely expected. But I think there were actually 2 interesting surprises. And the first one is that Jerome Powell has decided to stay on the voting committee for now, even though he won't be the chair, which is unusual. And the second is that a lot of committee members are closer to thinking about rate hikes than many expected. So Kevin Warsh, highly likely to be confirmed as the next Fed chair, and he'll be in place at the next meeting in mid-June. Now, even though President Trump wants him to cut rates, it seems like the rest of the voting committee are now moving against that.
Mid-June. Feels so far away, David. Anything could happen by then. All right, let's wrap it up there. Thank you so much for stopping by, and we'll see you next month.
Thank you, Lyndon. See you then.
See you then. And that is a wrap for today. Now, remember, you can find us and subscribe wherever you get your podcasts. That could be Apple Podcasts or Spotify and the like. We are also featured on the UniSuper YouTube channel, so you can subscribe to us there. Or failing that, check unisuper.com.au/podcasts at the start of each month. Now, a reminder that Chief Investment Officer John Pearce released his latest investment update video last week, and it was actually a really insightful one, so definitely head to our website, or again, the UniSuper YouTube channel, to check that one out. We are UniSuper, the place where bright minds and passionate people strive to think great and create a future worth retiring for. If you'd like to learn more about our investments, visit unisuper.com.au. Thank you for listening, and we'll see you next time. This podcast is general in nature, and it doesn't take into account your financial situation, needs, or objectives. So before you make any decisions about your super, we recommend that you seek financial advice first. Also, make sure you've had a read of the product disclosure statement and the target market determination that's relevant to you. They are all available on our website. It goes without saying that the past performance of any investment options that we talk about isn't indicative of their future performance, and it's worth noting as well that just by talking about certain companies, we aren't endorsing them for you to include in your own portfolio. Also, probably not a bad idea to mention that certain information contained in this podcast may include forward-looking statements, and we obviously don't guarantee that those statements will eventuate. And lastly, UniSuper has no obligation to provide updates or changes to the information in this podcast.